So the authors are curious to know which factors are most robust that's been found in the literature. So they searched the SSRN for the most papers related to factors, and they found the illiquidity, low beta, value, momentum, size, and quality factors. And so here they've gone back and performed robustness tests for each of those factors over a number of years. So the first factor is the low beta factor. They looked at the US from 67 to 2014 and international data from 87 to 2014. But the premise is that low beta stocks throughout history, on average, have outperformed high beta stocks, with beta being the coefficient of the excess market return on, or the equity risk premium in the CAPM formula. So what they've done is follow the Fama French strategy in their prior papers, gone long the low beta stocks and short the high beta stocks to at the same time to see what's the difference in returns in a zero cost portfolio. They split it up between large cap, small cap, and combined as well. The first thing we can see is that the volatility of the low beta stocks is a lot lower than the volatility of the high beta stocks, and that would make sense. And as far as the return goes, we can see the difference in return isn't necessarily statistically significant, which the t statistic would have to be probably above 2 or so. And that's across all of the different measures of beta, for instance, the 3-year or other measurements, and across all the size of the companies. But once we get down into looking at the Sharpe ratio, which may be more in line with investors who are long only, they would really care more about the Sharpe ratio of owning low beta versus high beta. And here we find that the t statistic is more significant for the Sharpe ratio. For instance, low beta stocks earned Sharpe ratios of above 0.5 in most cases. High beta stocks earned a lot smaller Sharpe ratios, and this is maybe because the high beta stocks are so volatile that that the return isn't as much compensation for that risk as it is in the low beta. And looks like we've got the same scenario for the international side as well. The returns seem to be higher for low beta than high beta, but not necessarily statistically significant, so that would mean we can't really say that this difference is likely more than 0. And the Sharpe ratios we see here, kind of similar to the US market. T statistics are a little more all over the place, but in most cases we can be confident at a 5% level that low beta stocks outperform high beta stocks on a Sharpe ratio basis over the past 50 years or so. And so they've done the same thing with the value factor, which would be owning value or going long value and going short growth companies, with the premise that value companies outperform growth companies on average over long periods of time. Over here they've got different measures of value, for instance, book to price, earnings to price, dividends yield, and also large cap, small cap, and combined. And we see at first glance, yeah, the value companies outperformed the growth companies in all cases, and in a lot of the cases for the different valuation measures, the t statistic is significant, so we could be confident that they did likely at a 5% level outperform growth companies. So going down and looking at the Sharpe ratio, we see the same scenario. The Sharpe ratio of the value companies was looks like more than double the Sharpe ratio of the growth companies, and this is statistically significant. On an international scale, looks like we find that to be the case as well, where the value companies outperform the growth companies. and this is statistically significant in most cases, except in the UK. And from a Sharpe ratio perspective, which is basically it's the return divided by the volatility, we find significance as well, except in the UK. So UK is not a very good spot for value investing, it appears. But in all of the other international economies, we can see that investing in the value companies outperforms growth companies on average from a risk-adjusted Sharpe ratio perspective. Okay, so now let's look at the size factor. So we've got the same analysis as before, but we've got a 50-50 small big portfolio, 75-25 small big, 25-75 small big. And at first glance, we see that the small companies are a lot more volatile than big companies, and that makes sense. The return of small companies is bigger than the return of the large companies over this period of time, and that's statistically significant in most cases, except the small 25-75 small big portfolio. So we can maybe conclude that it's likely that small companies outperform big companies on a nominal return basis. But going down and looking at the Sharpe ratio, we see that's not necessarily the case from a risk-adjusted basis. Where actually the Sharpe ratios of small companies are pretty much about the same as the Sharpe ratio of the big companies. So that would tell us that maybe the return that we're getting on small companies doesn't really compensate us for the risk of the volatility of those companies that we get. And we see that the significance is there's no significance related to the difference in those returns regarding the Sharpe ratio. And from an international perspective, we see there's really not a statistically significant difference between the returns of small and big companies, except in the US. So in other geographical regions, it doesn't appear that small companies outperform big companies, at least over this period of time that we're looking at. And we see the same conclusion down here when we look at the Sharpe ratios, where the Sharpe ratios don't necessarily statistically outperform, or the small companies don't outperform the big companies from a statistical basis, which would mean we can't really say that the difference between these two is more than zero. Okay, let's look at the momentum factor. We've got the same analysis where, the strategy is to go long past winners and go short past losers. And we've got different periods of time that have been found in the literature. For instance, looking back a year, looking back 6 months, holding for 3 months, holding for a year. And we've got also split up between large cap, small cap, and combined companies that reflect momentum characteristics. And interesting to see when we're looking just at large cap companies, there doesn't really seem to be a statistical difference between the returns of winners or past winners and returns of past losers. But when we're just looking at small cap companies only, we see that there is a statistically significant difference, where actually a really big difference, where returns of winners were almost 18%. Returns of losers were down to 3%. So that's a pretty big difference and statistically significant. From a combined perspective of small and large cap, we see that there is statistically significant difference in some of the cases. So going down and looking at the Sharpe ratio perspective, which would be the risk-adjusted return, are we getting enough return for the risks that we're taking? And we see that in most of the cases, the Sharpe ratio of the winners is more than the Sharpe ratio of the losers. But in some of them, it's not statistically significant, especially in the large caps. The small caps, we do see that that's statistically significant, and in the combined case. So we could say that small companies provide us a lot of return for the volatility that we have to undergo, and these are pretty big T statistics. I'll be willing to bet that they're above or below the 1% significance level. In fact, this is a really big difference. For instance, this strategy 0.61 excess return compared to negative 0.05 excess return, which is deficit actually. Looking at the international perspective, looks like the returns of winners exceed the returns of losers in all geographical regions, but there's not, the only one that's statistically significant is the UK. So we might not be able to conclude that winners outperform losers on an international scale, or the past winners past with losers. Although we do see that small caps does work out, whereas statistically we might conclude that past winners outperform past losers, except in Japan. Not a very good momentum investing area in Japan. The combined works out as well. So from a Sharpe ratio perspective, and this would be more in line with a long-only investor, we see the returns of past winners usually outperforms the past losers on a risk-adjusted basis, and this is statistically significant in most cases, except for Japan, as we found above in the zero-cost portfolio. Next, we have the illiquidity factor. The illiquidity factor is somewhat related to the small cap or the size factor as well, where small stocks are most likely the more illiquid stocks as well. So we should see some similarities there with the thought process that more illiquid stocks should earn a higher return than less or more liquid stocks. And we see that's the case here, where we get a higher return for illiquid stocks than we do for liquid stocks. And interestingly, the volatility is about the same and actually maybe lower for the illiquid stocks. And so the T statistic on the zero cost portfolio is significant, so we could pretty much conclude at a 5% level illiquid stocks outperformed liquid stocks over this time period in the US. And we've got different time periods and measures for liquidity there as well. We reached the same conclusion from a Sharpe ratio perspective. So from a risk-return basis for a long-only investor, we could say that investing in illiquid stocks outperforms investing in liquid stocks in all cases. And it's statistically significant as well. In an international perspective, it doesn't really turn out to be the case. We see in the US it worked out, but in the UK, ex-UK, Europe, Japan, and globally, the T statistics aren't significant, so we can't really conclude that investing in illiquid stocks outperforms liquid stocks. And from a Sharpe ratio perspective, we reach the same conclusion. So investing in the US, you get a return premium from investing in illiquid stocks instead of liquid ones, but in other countries, maybe not so much. And finally, the quality factor. It's been found that investing in quality stocks will earn you a higher return than investing in junk stocks. And this can be measured in different ways, for instance, gross profitability, return on equity, so on and so forth. And so the authors here are comparing quality to junk returns and over this period. So T statistic is insignificant in most all cases, except small caps. So we might conclude that investing in quality stocks over junk stocks may not earn you an excess return. From a Sharpe ratio perspective, that's still the case, where investing in quality maybe doesn't earn you a higher return than investing in junk stocks from a risk-adjusted basis. Internationally, we reach the same conclusion, where it may not be beneficial to invest in quality stocks over junk stocks. We do see a few cases, though, like Europe ex-UK and the global index workout. So next I look at a few other characteristics of the portfolios from the perspective of, first from a long-only investor, and these are a few other risk-related characteristics that investors might be interested in seeing. So they've got all the factors that we looked at previously in large cap only and small cap only. So first we can look at the volatility. We see that the low beta strategy is the least volatile, and that would make sense. The momentum strategy is the most volatile, at least in the large caps. From a small cap perspective, all of these are more volatile than the large caps, and that would make sense. But in this case, the low beta is still the lowest volatility, but the value companies are the highest volatility. And maybe since these are small caps, it makes more sense that the deep value companies maybe are more volatile because they're maybe a little more distressed than maybe the large cap value companies. And next we can look at some peak to trough um, scenarios here. We see the value companies will have the highest drawdowns in both large and small cap. The low beta factor is the smallest drawdown, so risk averse investors may find benefit from owning the low beta stocks. And the number of years of that decline are pretty much in line, except the market for small caps. It looks like maybe 6 years um, for the decline in the stock price here. And to recover from that trough, it looks like quality factors took the longest in the large caps, and otherwise it was pretty much 2 to 3 years to recover. And the longest period of underperformance is related to the quality factor. So investors might be wary of investing in the quality factor if they want to avert from that risk. And then the long short portfolio. It's by going long that factor and short the opposite side of that factor and owning a zero cost portfolio. And just from a quick glance, this low beta portfolio provides significant risk. It looks like it's got pretty much the highest, at least in the large caps, it's got the highest volatility, the biggest drawdown, the longest period of underperformance, and it's pretty interesting to see because you would think that low beta would have the most riskless way of investing, but actually it turns out that going short the high beta stocks really leaves a lot of return on the table um, in good markets, in good bull markets. So maybe that zero cost portfolio isn't as beneficial as you might think. Same thing for quality, where it's by owning this zero cost portfolio, taking on a lot of risk of underperformance. And we get the same scenario in the small cap side as well, where low beta size in the zero cost portfolio looks like a pretty big drawdown or period of underperformance as well. And so finally, the authors look at the factors we looked at before on an after transaction cost basis to see um, is it actually practical to employ these strategies in the real world and you actually get a premium from investing in them. So the first one is the value strategy, and we've got all the different methods that we looked at before. And we can see that before transaction costs, we got about 2.7%. After transaction costs, 1.7%. So that's not bad of a decrease once we factor in transaction costs. Small cap portfolio obviously looks like it's a little more costly to employ that strategy. From a momentum perspective, we had positive returns before transaction costs, but after we consider transaction costs, we actually kind of have a negative um, added value from that factor. The low volatility, the low beta strategy, we got a little bit of a decrease in the return once we add transaction costs, but it's still a positive added value from that factor. quality goes to a negative factor, liquidity goes negative as well, except in small caps we've got a positive value from that factor, and the size factor will remain positive, but the value is kind of split in half. So we could say that looks like maybe only the value, small cap, low volatility, the illiquidity, and size factors are still useful to use after considering transaction costs.